AMMs didn't need to be only the simple version of X times Y equals K, which implies that the pool always has like the same amount of value in both tokens, and discovered that it's possible to have any number of tokens with any weights that you want, like pretty similar to what an index fund or an ETF would look like. And that was Balancer V1. We launched in 2020. And since then, we went more from an end user focused protocol to a developer focused protocol where people can build their own AMM innovations on top of Balancer. So we went in that direction with Balancer V2. There are people who say like AMMs are what they are now and there's not much to do. But then we see a lot of interesting things like priority fee mechanisms. Balancer V3 is a bet that this is going to keep happening, and we want to be this platform for people to try new things around AMM design.
Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization in the blockchain revolution. I'm Friederike Ernst, and today I'm speaking with Fernando Martinelli, the co-founder of Balancer Protocol. Before I speak with Fernando, let me tell you about our sponsors this week, though. If you're looking to stake your crypto with confidence, look no further than Chorus One. More than 150,000 delegators, including institutions like BitGo, Pantera Capital, and Ledger, trust Chorus One with their assets. They support over 50 blockchains and are leaders in governance on networks like Cosmos, ensuring your stake is responsibly managed. Thanks to their advanced MEV research, you can also enjoy the highest staking rewards. You can stake directly from your preferred wallet, set up a white label node, restake your assets on EigenLayer or Symbiotic, or use their SDK for multi-chain staking in your app. Learn more at chorus.one and start staking today.
This episode is proudly brought to you by Gnosis, a collective dedicated to advancing a decentralized future. Gnosis leads innovation with Circles, Gnosis Pay, and Metri, reshaping open banking and money. With Hashi and Gnosis VPN, they're building a more resilient, privacy-focused internet. If you're looking for an L1 to launch your project, Gnosis Chain offers the same development environment as Ethereum with lower transaction fees. It's supported by over 200,000 validators, making Gnosis Chain a reliable and credibly neutral foundation for your applications. Gnosis DAO drives Gnosis governance, where every voice matters. Join the Gnosis community in the Gnosis DAO forum today. Deploy on the EVM-compatible Gnosis Chain or secure the network with just one GNO and affordable hardware. Start your decentralization journey today at gnosis.io.
Fernando, it's fantastic to have you back on. Last time you were on the show was actually 4 years ago. It's a really long time. Remind us.
In crypto, it's a generation or more.
Yeah, it's like in 4 years, it's at least one generation. So remind us, how did Balancer get started, and how has it developed since 2020 when we last had you on?
Yeah, so I've always been a fan of crypto in general, Bitcoin and Ethereum, and got involved in the early days of MakerDAO, worked with Rune and Nikolai, and was active in the discussions around AMMs. And it was the early days in 2017, even before that. And the idea came in 2018 when I realized that AMMs didn't need to be only the simple version of X times Y equals K, which implies that the pool always has 50-50, like the same amount of value in both tokens. So I kind of slept little for some nights and went through lots of maths and discovered that it's possible to have any number of tokens with any weights that you want, like pretty similar to what an index fund or an ETF would look like. And that was Balancer V1. We launched in 2020. And since then, how it evolved, we went more from an end user focused protocol to a developer focused protocol where people can build their own AMM innovations on top of Balancer. So we kind of went in that direction with Balancer V2. And even more so with Balancer V3, which we can talk about now. But it's been a long journey, and a lot of people now building on Balancer. So very, very glad that we're here still like doing interesting stuff. And yeah, very happy to be here with you again, Frederica.
Super nice. So maybe let's talk about the very early days of AMM. So kind of like in my view, kind of AMMs were very much developed as a stopgap measure because people had been used to central order book exchanges off-chain, but implementing them on-chain is actually very difficult because everything is ex ante. It's public, right? Kind of like, and you can front run things, and so that's kind of how AMMs kind of started off. How do you see the evolution of AMMs in this space? How have they matured?
Yeah, it's crazy how we learn things that today in hindsight feel just obvious, but it took us like a full 4 years maybe until today we're learning new stuff. But like only a year after we started the AMMs, we started discussing things about like impermanent loss, and then MEV, which then evolved to LVR, loss versus rebalancing. And we realized that there were lots of dark forest ARB bots that were being they're mean in a way, like sandwiching innocent users. And then things like CoW swap came around to make Ethereum more fair or fairer. And yeah, so there's been a lot of evolution. And then Uniswap came with their V3, changing the landscape with concentrated liquidity, which was definitely groundbreaking. But that itself introduced some new challenges, like just-in-time liquidity, where like LPs put 100% of their liquidity in a very short tick or narrow tick when a big swap happens, and then people who are providing liquidity with a longer range, they just they get their lunch eaten by those guys who only apply to that narrow tick, because they get proportionally almost all the fees. So with new innovation comes new challenges. And I think we're still learning today. There's lots of interesting things that we're doing at Balancer and others are doing as well around mitigating MEV and LVR and our profits, and really trying to return the let's say the profit or the surplus of the operations to the end user instead of to validators or to the MEV bots or arbors. We really want to make sure that the users get all of the the return for the risk they're taking by providing liquidity or by doing trades as innocent good flow, as we call them. So very excited. And I think Balancer V3 is all about this bet that AMMs are still in their infancy. There are people who say like AMMs are like what they are now, and there's not much to do. But then we see a lot of interesting things like priority fee mechanisms, like discussed by Dan Robinson, who's an OG and someone we all look up to, and yeah, some very interesting ideas that keep coming up. So I think Balancer V3 is a bet that this is going to keep happening, and we want to be this platform for people to try new things around AMM design. Yeah.
There's a lot to unpack here, and I think I kind of want to defer most of it until later in the episode. So, but I think we should note that AMMs are extremely susceptible to MEV and LVR, just because you're always at a disadvantage if you're the maker, right? Kind of like you ideally want to be the taker, and kind of like if you have stale liquidity and kind of like prices have changed, that's really detrimental. And then also on top of that, if someone kind of actually is a somewhat unsophisticated taker, this potential revenue that should accrue to the makers, it often actually goes to arbitrageurs. So kind of they kind of lose on both sides. And kind of I think kind of we should talk about how to mitigate MEV a little bit later. So kind of if when I think about other things that kind of have changed for AMMs over the past 4 years or so, it's kind of efficiency and cost reduction, right? Kind of like, so you talked about this simple constant product market maker, and kind of this also has changed dramatically, right?
Right. Exactly. Yeah, I think that there are this is definitely there are two examples of AMM innovation where efficiency comes in terms of capital efficiency, which means how much price depth or how much useful liquidity for traders, which is translated in terms of depth, how much you can trade for a given amount of dollars you deposit into a pool. And Curve came with the first, in my opinion, innovation in that regard for pegged tokens. And we also have an implementation of stable swap on Balancer. And and Uniswap also innovated in terms of making those positions non-fungible, so anyone can express their opinion in terms of what range they want to provide liquidity in, which has also its challenges. So yeah, I think there's different ways you can talk about efficiency and different challenges that those ways you solve efficiency bring to the table.
Mhm. So you already kind of mentioned kind of the main competitors in the AMM landscape. So there's Uniswap and Curve, and Curve very much launched with stables in mind, where kind of say you trade one USD stablecoin against another, and then kind of there's very high liquidity kind of at the point, kind of in the middle, so kind of you can trade them against each other really efficiently at kind of like even large sums, which is not usually the case with vanilla AMMs. And the other one is Uniswap. So kind of how would you say balances positioned with respect to both of these?
Yeah, we're a bit in the intersection and really exploring build your own AMM. So AMMs made easy. It's really kind of, you have those two, and then you have Balancer kind of an intersection, but also expanding through third party teams, like some of which we're going to talk about, like CoW Swap, building the CoW AMM with Balancer, and Gyroscope and Save Finance, and lots of others. So yeah, I think we are really positioning ourselves as a platform, not taking any preferences or any favorites, saying like we're gonna be just like many token pools. That is something that Curve can do, but it's not in a way that we can do, like with flexible weights and flexible AMM logic. So we can have up to 8 tokens per pool. And the main thing that we're not decided is strategically not to chase after, because we think that they already do a very good job at is concentrated liquidity. So Uniswap has pioneered that concept, and we believe that we can add more value to the space by focusing on fungible liquidity. So whenever you think of Balancer, you have a pool token that is like a representation of a share of a pool where all the users are equal. So there's no risk of, like, there are sophisticated players doing just-in-time liquidity. So there are LPs just for the transaction and take all the fees from the other poor LPs that are humans. So we solve this by focusing on fungible liquidity. But within fungible liquidity, you can have concentrated liquidity as well, which is something that Gyroscope is pioneering within Balancer. So it's a invariant shape that follows the shape of an ellipse. That's why it's an elliptical pool. ECLP, concentrated liquidity, elliptical concentrated liquidity pool. So there are other ways to do interesting stuff without giving up on the fungibility. So that's how I would put Balancer amongst the other competitors.
When you look at non-fungible and fungible liquidity, so to me it's pretty clear why non-fungible liquidity would be preferable in many instances, just because you can you can do very concentrated liquidity where you're comfortable kind of providing it, and kind of it's much better APY potentially if you're doing it right. What are the advantages of doing fungible liquidity?
Yeah, so fungible liquidity is really about setting a level playing field. Like you ensure that sophisticated players cannot come and grab your lunch using just-in-time liquidity. So it kind of sets a known and easy to manage, like something that I call set and forget, or deposit and forget. Whereas if you're dealing with concentrated liquidity, of course you can be more efficient and say, like, I want to trade ETH between 3,200 and 3,300, and I'm going to make more fees than people who have a UniV2 pool or a balancer pool. But like, you have to be very active. You have to make sure that as soon as your liquidity goes out of range, then you need to rebuy half of the tokens to go back to the play, or position your position, your LP position closer to where the price is, which means you're rebuying for more than you sold for, or you're selling for less than you bought for. So it comes with a lot of caveats. So I would say concentrated liquidity is better for active, more sophisticated, professional market makers, and fungible liquidity is better for I would say, like, passive LPs might be have not a better connotation, but I think that's what it is. Like, there's a lot of people who want to just put the money in an LP position and forget. So those are safe because the environment does not let active traders kind of come and eat their lunch, for example, through just-in-time liquidity or through more advanced techniques that the normal human passive LPs are not in a position to do or to perform.
That makes a lot of sense. So Balancer V3 just came out a short while ago. So what are the main goals of V3 over V2?
Yeah, so V3 is really taking that idea of Balancer is a platform for AMM innovation step further. So a lot of the hard work we put, and we spent like almost 2 years working on V3, maybe more, is really towards like making it easier for anyone to develop their own pool or to innovate with their own AMM idea. So the DevEx experience improved by 10x at least. It's very much easier, a lot easier to create your own pool. You only need to define an invariant, and that's it. All the functions like swap or add liquidity, remove liquidity, they all stem from this definition of invariant. Whereas in V2, you had to define all the different functions like swap in for out, swap out for in, and they could be conflicting. So you could have an AMM that is not consistent. So it took more care for AMM designers to make sure that everything was consistent. Whereas V3, as I said, you just like have this invariant, like the shape of the curve of your AMM, and then Balancer does everything. It does scaling, it does rounding, it makes sure that your AMM cannot be exploited through rounding, because we do like rounding at the vault level in the direction of the pool. So we're kind of taking away a lot of the burden that AMM designers needed to carry about, to worry about, sorry, in V2 to the vault. We have this idea of transient accounting. So you can do lots of transactions, add liquidity, remove liquidity, swap, and then at the end you settle your tab. Let's say like you're at a bar and you drink, and then just at the end you pay your bill. So it's similar. And by the way, a lot of the things we did for Balancer V3 are similar to some things that Uniswap V4 also has. We even changed our names to make sure that we had the same names as Uni before, because we want people to that are used to Uniswap before to also look at Balancer V3 and see if it's a good or a better fit. So we also have hooks which make it easy for specific things that you do before and after the swap to be applied to a different set of pools without having to rewrite all the pool code, which was possible in V2. So you can always deploy a pool with with specific code that is customized by you. So with the hooks on Balancer v3, you can just reuse hooks that exist, and we have a few examples of that. And maybe the coolest thing for the end user, I think, about Balancer v3 is the new idea of boosted pools, 100% boosted pools. We had that in Balancer v2, and we're improving that by making, like before, they weren't 100% boosted. We're making them 100% boosted. And we do that by, and it's kind of technical. So yeah, maybe I'll just stop here and I can talk more about how it works, Federica. But I'm very excited about boosted pools. So which means that instead of like having to choose between lending your, say, DAI or USDC on Aave, or adding liquidity to an LP with your USDC and DAI or USDC and ETH, you can do both. Like you can add liquidity using your DAI, and then under the hood, Balancer will deploy all that DAI to Aave and turn it into a DAI. So people are trading DAI in USC or DAI in WEF, but in the under the hood, Balancer is making sure that this is being lent out to Aave, and all of your position is earning yield. So this is pretty cool.
And that's super cool because yields on particularly at US dollar stables are really high. So kind of competing with this kind of as a liquidity provider is really difficult. Tell us how this works under the hood and kind of why it was difficult to going from partially boosted pools to fully boosted pools.
Great question. Yeah. So the way so first, why is it difficult? Like in essence, it's not hard. Like what you can do in Curve does that, but it's not very popular because of the reason why it's not simple to do it, which is like you could just have all the liquidity go to A tokens. Let's use Aave as an example, but it could be other lending protocols. So if you want to have like both the swap fees, like being an LP, and also have the lending protocol, you can just put your A DAI paired with an A USDC on Balancer, and then people can trade A DAI for A USDC. But this is not what people want to trade. People have DAI, people have USDC. They don't have A USDC or A DAI or the wrapped version of those tokens. So really, the trading happens in the underlying token, right? In DAI and USDC, not in lending wrapped versions of those tokens. So you could solve that by having very kind of sophisticated aggregator like logic, which 1inch has and others like CoW also have. You can abstract away that from the end user and say to the end user, you're trading DAI for USDC, but I am going to Aave, I'm going to wrap it, and then I'm going to trade on Balancer, and then I'm going to give it back to Aave, and do all that back and forth, which costs a lot of gas. So this is quite hard to do because of a lot of gas. So what we did to solve this in Balancer v3, and no one has that, so it's a pretty unique feature, which is what we call buffers. So what we do is very simply, we have it's like a mini instance of Aave inside the Balancer vault, which has like a little bit of a DAI and a little bit of DAI. And then everybody who trades using Balancer's vault, they trade, actually, they see DAI as liquidity, but they trade with in the pool that has a DAI and AUSDC, which is earning 100% of yield for LPs. But then Balancer, the vault, looks at the buffer. So the buffer is kind of has a DAI and DAI and wraps with the same rate as Aave, but much cheaper because it only reads the rate that Aave is offering without having to, if you had to wrap using Aave or unwrap, you would have to do all the update of the accounting of the whole like pool of Aave. So that's quite gas intensive. Even though Aave is super efficient and has improved efficiency over time, it's still quite gas heavy. So what we do is we use this buffer, and then like let's say you trade a little bit of DAI for USDC. You put DAI in the vault. The vault puts DAI in this buffer, takes some wrapped or some A DAI, trades with the pool that has a DAI in USDC, and then the AUSDC goes to the buffer of USDC, and then the user gets USDC. So the user has the like the experience of trading DAI for USDC, and there's no external calls to Aave because the buffers of DAI and USDC are enabling that trade. Then, of course, what can happen is the buffer doesn't have enough DAI or USDC to give back to the user because the user is doing a big trade. That's where I think the cool thing happens is that when the buffer goes back and forth, and then whenever there's a big trade, then the buffer doesn't have enough. So balancer knows that, the vault knows that, and goes to Aave and then wraps or unwraps exactly the amount needed for the trade to be executed, plus putting the buffer back in the middle, which means that this user that did a big trade, they're paying for the buffer to be put into the sweet spot, which is right in the middle. So for next trades, smaller trades, it can go back and forth, and still save a lot of gas for subsequent trades. So this is something really neat that I think we are just starting to explore. And one thing that I think a lot of people think is that in layer 2, it's not very relevant how much gas you spend because gas is so cheap. More so on ZK rollups because it's really a free processing. But I think that it still can make a difference between like two sources of liquidity, say Balancer and Uniswap. If Balancer has slightly less gas for that trade, then that liquidity will be used by solvers on CowSwap or by 1inch or whatever aggregator, Matcha. So I do think that the gas discussion, even though less relevant for L2s, it can still be like a differentiator for sources of liquidity.
It will also become more relevant again once blobs fill up, right? So kind of like,
Exactly.
I mean, the only reason why L2s are currently as cheap as they are is because kind of blob space is pretty abundant.
100%. We'll always be reaching that scalability like moment where like, oh, things are going to be expensive because we filled up the ledger and we need more space and fees go up. So yeah, absolutely.
How baked into the design is Aave? Could you in principle kind of switch this out for another money market, or does it have to be Aave? Or will there be other versions that kind of use a different money market?
So Aave is definitely our preferred partner. We've been together for a long time. We're very close, and they used Bouncer for their 80/20 pool for providing liquidity in the Aave token. So it's also the longest, most battle-tested protocol around. So we're definitely kind of biased towards Aave, but the protocol is neutral. So the smart contracts work with a wrapper, which is 4626. So as long as your token is 4626 compatible, then you can use a boosted pool. So other protocols like Morpho and Euler's looking into it. There's also already other protocols that have boosted pools on Balancer already. So it's definitely an open thing, but of course we kind of have at least in the UI, and the UI is controlled by its own team that has their own opinions. But I think the standard option is Aave, so it's just because we trust them so much.
Cool. Yeah, that makes sense. When you say kind of it's fully boosted, I take it the part that's not boosted is the buffer, right? And I mean, the size of the buffer kind of has to be somewhat in relation to the total pool size and the average trade size, I assume.
Exactly.
So kind of like when you say fully, it's probably like 95 or whatever %, right?
It is full because that's a great question. The buffer is not paid or is not filled by the LPs. So the LPs.
Oh, okay.
Yeah, the LPs only put their liquidity in the pool. And by the way, if there is no buffer, it's fine because that means that all the transactions will have to wrap and unwrap
additional gas. Yeah.
using exactly. So it's just a plus. If you have a buffer, it reduces gas for most of the trades. And like you said, perfectly put. Like depending on how big the buffer is, the more trades it can enable without having to resort to an external call. How we deal with buffer so far is the projects are putting liquidity there, because like protocols usually have protocol on liquidity, so you don't need a lot to enable most of the trades in the buffers. So protocols that are creating boosted pools are putting 100K, sometimes 200K in the tokens that they want to boost. And very nice as well is that one token is so you only need one buffer to boost a token, and that token can be in many different pools. So if you have a buffer for DAI and ADAI, then ADAI can be in like ADAI USDC, ADAI ETH, ADAI whatever. And every time you do this lag, which is boosted DAI, then you use the same buffer. So it's kind of a shared common good that helps everyone to save gas.
Cool. Yeah, that makes a lot of sense. So when we talked about kind of like new features for V3, kind of the first thing that you kind of mentioned was improved dev experience. So kind of like making it easier for devs to kind of build good, well-designed AMMs on top of Balancer. And the other thing that kind of you mentioned but didn't really go into was hooks. I'm interested in this. So kind of hooks are kind of modular customizations. Tell us about what kind of logic you see and what kind of logic you expect to see in the future.
Great question. So hooks are really like this very interesting way to open up experimentation without creating dangers for developers or LPs, and also kind of reutilizing code that's battle tested. So that's the beauty of hooks, in my opinion. An example of interesting hook is you change the swap fee based on whatever parameter. For example, priority fees. Those are very useful for mitigating MAV or LVR in chains that are priority fee sequenced. An example is
L2s,
Base.
right?
L2s, yeah. So Base is it can change. There's nothing set in stone, but differently from Ethereum L1, they just take like the transactions and order them by priority and execute them. The Base, like Coinbase, is not interested in doing money with MEV, at least so far, thankfully. Yeah. So if you're trying to be a MAV bot and you want to capture a very good opportunity, let's say sandwich someone, to be able to get that opportunity, what you're going to do is you're going to put a high priority fee for you to be like the first one to get it, right? What we do is we have a hook that says read the priority fee, which is something that is like readable in the transaction, and then we say like that priority fee, if it's above a threshold, which is kind of to safeguard users that are using MetaMask or other wallets that always have some small priority fee as standard, up to 5 GUI, for example. If you pass that threshold, then you're considered to be a bot that's trying to extract MAV from the poor LPs
And
who
that's
should
because kind of you're paying to kind of be early in the sequence and kind of like get to fulfill some sort of vulnerability or kind of like up against something that won't be there for a long time, right? Kind of like
exactly.
Okay.
Perfect. Exactly. So what we do is like we calculate the swap fee of the AMM. So we make the price worse, less attractive, as much or proportionally to how much the priority fee goes up. So if we read a transaction that has a very high priority fee, we increase the swap fee to extract more value to the LPs. So this way, we effectively make sure that if you're trying to get MEV by paying too much to the sequencer, we say the price is worse. So it's kind of a very, very interesting way to say the share of profit that this MAV opportunity created will go to our users and not to you,
It's
bot.
like tax the bots.
Exactly. It's based on an article. I don't think it was the first article talking about that, but Dan Robinson, as I mentioned, wrote a very interesting paper on this, and we're like implementing it. I think it's the first AMM that's doing that. So the very flexible infrastructure of Balancer V3 allows that, and I think we're launching it like next week or so. We're already it's already audited. So, and also the cool thing, as I mentioned, of hooks is that they only have a very small surface of kind of interaction or a surface of attack, because with a swap hook you cannot it's a view function. You cannot it only returns the new swap amount and swap percentage, and that itself cannot it's probably not something that can drain the AMM or put LPs in risk, because the worst it gets is the fee goes to 100%, and then the trade is like it. No one is going to trade with that pool, but it cannot be negative, which would be draining the pool. So it's something that people can just interact and innovate, iterate a lot without the risks that AMM design bring with it.
Cool. What other hooks are you working on or looking forward to?
Yeah, so we have the priority fee hook. We have the stable surge hook, which is very interesting as well. So if you have a stable pool, so two assets that are correlated like USDC and DAI, if the peg is lost or is broken, then you have like, I don't know, let's say DAI for 70 cents. The stable surge hook, what it does is it charges a higher fee towards the side that you don't want the pool to go. So if you want to dump more DAI and make the peg go even worse, there's a higher fee. Whereas the fee that brings the pool back to the peg to where we want it to be is lower or even zero. Can't be negative because that opens up problems, but it can be virtually zero. So we kind of incentivize the spreads to go towards where we want the pool to go. So that's an interesting one.
What do you do if a stable kind of depegs for a good reason, right? Kind of like, so for instance, say someone has invoked the global settlement with Maker and then kind of DAI depegs. I mean, that's pretty reasonable. Wouldn't you have to kind of disable this hook?
No, because that's a good question. Like what the hook would do is it would just like not enable trades in that direction. So let's say the swap fee or spread grows a lot. So there's no trades between 80 cents for a DAI and 60 cents. So even though the price is like 79, right? It's almost 80, which is the upper margin where we want the AMM to trade. It still has all that margin to go back and forth till the 60, where our AMM is just saving our users. So in a way, it's protecting the LPs by not giving away more, let's say USDC, which is the one that's still at $1, because yeah, it's not worth it. So it's a trade-off between swap fees. So we give up on being traded on, so generating swap fees, because there's a lot of cases, or most cases, when the peg is broken, it's something that could be dangerous, and it could mean that there's a problem in one of the tokens, and then the pool will just get drained or drain all the good tokens. So that's another cool thing of the stable strategy. The more you get to the peg being broken, the more you protect the token that's still in peg, and you don't sell it. So yeah, it's fine. You don't need to deactivate it, but you still like you trade less. It's like giving up on swap fees for the chance protecting LPs, and in the event that depeg is not going to be permanent, or is something like temporary or related to a bug or some instability of the system.
But as an LP, you're always allowed to withdraw, I assume.
Anytime.
Okay.
Yeah, that's a premise that Balancer has. It's actually enforced by the vault. We have functions that allow the LPs to withdraw their liquidity without even talking to the pool contract at all. So and that's just super important. Like any pool that has code that could be broken because of a bug or whatever. Balance the vault enable. It's almost like, now that I think of it, it's almost like the L2s kind of having this forced exit mechanism. You know, if the L2s stop creating blocks, then you can go to the L1 and just force a withdrawal of your L2 funds and bridge them back. So it's kind of similar. The vault doesn't need to talk to the pool to allow users to withdraw their funds.
Yeah, I think a lot of L2s don't actually have this implemented yet. But
they say they have, or they say they will have, or they should have. But
we're
yeah,
going to get to this eventually. We will be
exactly.
more
It's
than
one
a
of the
meme.
stages of the ladder of L2s, right?
Cool. You alluded to this kind of like in the very beginning of the podcast. So kind of you talked about MEV mitigation. Kind of we already touched on this kind of with the priority fee hook, where kind of you surmise that kind of like anyone who's willing to pay a higher tip is probably trying to do something extractive and is not just trying to be nice to the sequencer. So there's another MEV resistance mechanism with CoW AMM. Can we talk about that? Because kind of like that's less circumstantial in a way. Kind of right with the priority fee hook, kind of you're just assuming that because someone is willing to pay for the first spot, that they're trying to do something malicious or extractive. How does it work with the CoW AMM?
Great question. Yeah, as always, it's like a trade-off. I think my personal preference is what CowSwap does, or the CoW AMM that's powered by CowSwap, which is really to take a step back. Like MEV stems from the fact that there is adverse selection. So there is an unfair, as you said, Frederico, like the LPs are like, they are on chain. Like you cannot update prices instantly. There's like block times, and there's gas costs to change things on chain. Whereas traders, they have instant information. You have like all sorts of flow of transactions and mempool. So you have a lot more oversight of the price of assets. You have access to all the off-chain information. So it's really an unfair game. What CowSwap does, and I'm a big fan of CowSwap, by the way, is like they bring this knowledge to the table by having this competition between solvers, and they make sure that there's a surplus that has to go to the users, and the solver that maximizes surplus to the users, in this case the CoW AMM, is considered a user, which is like the whole novelty of this design. Like usually only users that put trades on CowSwap are considered users, and they get the surplus. For CoW AMM, the AMM itself is like a user, so it also has like the surplus included in the calculation for the winning solver. So it really, so CowSwap allows this this kind of disadvantage of on-chain LPs to kind of be counterbalanced. So with CoW AMM, you are sure that you are selling whatever you have in your AMM pool for the market price, because there is competition between solvers, and the one that provides the CoW AMM with the most surplus is the one that's going to win. So it's really like you have like a swap fee that is it's variable. So like I said, like you can increase the swap fee to give more value to the LPs by looking at the priority fee, or you can increase the swap fee by looking at how the competition between the solvers is willing to give more to the LPs to get this trade. So it's two ways of returning value to the LPs, and I like it a lot because it's just, it has more information from the whole ecosystem. It's not just some math bots that are doing like trying to extract and giving to the sequencer through priority fees. it really involves all the solvers of CoW, which is getting bigger and bigger and has more and more participants. So it's fair and fair. But the problem is the downside is that it's not permissionless as the priority fee hook. So the priority fee hook, the beauty of it is that it's like open, anyone can post their transaction on the base sequencer. Whereas for CoW AMMs, it works if you allow only solvers of CoW or CoW to interact with that liquidity. So it's that trade-off. But in my opinion, as CoW grows bigger and bigger, and there's lots of solvers and a lot of diversity in the solver ecosystem, I think this is a trade-off that we're willing to do. And we're going to publish some results soon, but we're super excited. Like with smaller pools on CoW AMMs, we have much better APRs from swap fees than like compared to balancer, vanilla weighted pools or Uniswap V2 pools. Like they, even being a lot bigger, CoW AMM pools are doing a lot more APR, so kind of protecting the users and giving back, swap fees to them as compared to the conventional Uniswap V2 or balancer AMMs, which is amazing. Something we're going to be building on more and more, and we're going to expand CoW AMMs to balancer V3, which is something we're working on right now.
Are there kind of like benchmarks that you can give us? So kind of like how much more APR can I expect to kind of get as a CoW AMM LP?
So I've just today seen some numbers by the CoW swap team, and it's sometimes like 4-5% annualized in pools that are much smaller. So the results are really promising. And I'm not gonna give you any hard numbers because I might be wrong, and more judicious analysis has to be done. But it's as much as like 5% annualized more. But it makes sense, right? Because like what CoW does is really like it lets people trade with the price of the market, even though the pool has a stale price, like you said, Fernando. The competition ensures that the pool gets its fair value for the assets, which increases the APR considerably.
So toxic order flow is effectively just filtered out.
Perfect. That's right. Yeah.
Cool. One more thing that we also kind of like tangentially already touched on, and that's kind of scalability and kind of your L2 and multi-chain strategy. Kind of like what we've seen increasingly in kind of like the Ethereum ecosystem is that liquidity has splintered dramatically between different L2s, and contrary to kind of what we had hoped for initially, these L2s are very much not interoperable. So kind of like despite the fact that they have this shared security layer, you still have really long settlement time. So in principle, kind of like say, you go from Arbitrum to base and back, it'll take you 2 weeks. You might as well kind of send a postcard to the other side of the world, right? So kind of so what you actually have is you have arbitrage between different L2s, and kind of like it's very liquidity intensive and so on. How do you guys think about balances, kind of multi-chain and multi-L2 strategy?
That's a very hard question, and like I'm just representing my views. I can't speak for all the balancer community, but I do think that this is such a hard problem, and one that a lot of people are working on. Very, very good people, much more intelligent than me for sure, but probably than our team, and with a lot more resources. So I do think that we should not try to create new protocols for cross-chain swaps or things like that. I think we should try to kind of stay in our lane and make sure what we do the best we can. And yeah, I'm not a fan of going the app chain route. I think this is going to cause even more fragmentation, like you said. Even if you're part of the super optimistic chain, or you have a base roll up. I think there is always fragmentation that is going to happen. Maybe it's solved in future, and again, I hope that those brilliant minds in the Ethereum space are going to be able to solve it. As a user, it hurts me a lot to have that fragmentation. Like I said, it's not good UX, and goes like in the direction of all the like Solana versus ETH, like North Star and everything that I don't think we need to get into. But so yeah, we are trying to be as good as we can in what we do. But when it comes to our strategy for multi-chain, we want to be in the chains that our partners require or want us to be. So we don't want to be on all chains, because it does kind of dilute, capacity of the team and making sure we can execute with excellence. So, but given we are a protocol for others to build on top, we have to be on the chains that our partners, like, QuantAMM, they have very interesting kind of strategies that use ZK proofs. We haven't talked about them, but I hope we have some time too. But yeah, teams like them, like they want to be on ZK Sync or whatever chain. It's kind of how we're approaching our strategy. We want to be supporting the teams built on top of Balancer and our close partners as much as possible. And we're not tackling directly the challenge of like cross chain swaps or liquidity. Yeah, at the moment, at least.
Yeah, I think that's fair. It's a hard problem. Let's kind of dive into the other bigger projects building on top of balances. So kind of you already mentioned QuantAMM. I'd be super interested to kind of hear more about them. The other thing that kind of really piqued my attention was Gyroscope. So maybe you can give us kind of like a short overview of what they do and how they leverage Balancer.
Sure. Yeah. So disclosure, I am an investor, an angel investor in both those protocols. So I'm biased, but I do think they're amazing. Gyroscope has been around for a long time. They are basically, the initial idea is, and I think it expanded a bit, but is to have this GYD coin, which is a stable coin that is based on like how to compartmentalize risk and making sure that whatever you have in your basket of assets that collateralize your stable coin, if something fails or goes off bag, you still have the kind of the system dynamics to avoid like a depeg of this coin that is basically built by collateralized AMM pools on top of Balancer. So it's quite big brain stuff, but has been created by really brilliant guys that from the UK that I've been very very much a fan of since the early days, and I think they've been around for maybe 4 years already. So yeah, they also created the ECLP that I mentioned. It's a very gas efficient AMM based on elliptical curves or elliptic curves. So they are amazing, and they have built on Balancer V2 and are now migrating to Balancer V3. And kind of as an aside, it was great to see how the DevEx increased or improved, because most of the migration process was like deleting code. You delete this, and it's very, very much a watered down version of V2 is what they need for V3. So kind of validated our hopes of improving UX. QuantAMM is really about like this initial like original idea of Balancer as an index fund, and it's actually something we're pursuing not only with QuantAMM but with CoW AMMs and CoWSwap as partners. This idea of like index funds and ETFs on chain. Like the main reason why, and I'll talk about that, but just QuantAMM, it's really like how to have indices and ETFs or exposure of like a pool of assets with a very smart kind of management that's done on chain potentially with ZK proof. So you have very complex strategies that you don't want to make public for people to kind of copy you or front run you. So they have strategies that are all implemented on chain, but use ZK proofs or ZK chains to make sure that it can be implemented on chain without disclosing what it is and in a gas efficient manner. So it's really like using Balancer V3 as an asset manager and doing very sophisticated strategies. We're very excited about them. They got a grant, they got funding from other VCs, and we're launching. I think they're already in beta, and they're going to be quite big. I think on Balancer V3. So I was saying about apart from QuantAMM, this idea of indices and ETFs. I think we have tried that in the past, and I think it was just not the time. It was too early. It's like
I know that feeling.
Like MySpace, and then Facebook comes at the right time, executing the right way. So I think the one thing that was missing back then and was the cause for indices like index co-op, which I love. I think the idea was great. Like they leaked a lot of value because of this adverse selection. Like arbors and traders have off-chain information, and they just extract slowly the value from those indices by having better prices than the market. But now we have the tools we just talked about to prevent math. So all of a sudden, indices on chain are a thing again. So you can have exposure to NVIDIA and other like assets, real world assets, and have an index fund on Balancer. By the way, we launched with the help of actually their initiative, Carpet Key, which is part of the Gnosis family, as you know. Amazing guys. They together with Backed, they launched the first pool where you can trade assets and stocks like NVIDIA, and you can only do that on Balancer. So that is something that excites me a lot about the future of Balancer and AMMs in general.
And it's got amazing yield as well. So
exactly.
It's like I'll make sure my lawyers don't hear this. Otherwise, kind of like they'll
not investment
they'll
advice.
make me delete it for financial promotion. But I mean, it's kind of like the yields you can currently get on chain. It's kind of in things that are not inherently risky or not inherently more risky than doing it on Robinhood. Is insane.
Exactly.
So Fernando, kind of like when I kind of zoom out a bit, kind of I heard two somewhat different stories about kind of like who you guys are catering to, right? Kind of like on one hand, you're catering to people who just want to let their capital sit there and not be sophisticated traders. And on the other hand, you're kind of looking to cater to protocols. So kind of like if I were kind of a business person, kind of I would kind of differentiate these into kind of like B2C and B2B2C kind of branches. How do you think about them, and how difficult is it to kind of like corral them into one product suite?
That's great question, and I agree with you that impression might be floating around for listeners or for you. So the way I would frame it is like the end goal is really to be a platform for others to build on top and innovate using their own AMM ideas. So the focus is for others to build on Balancer. And I would say that what we're doing by having our own types of pools or joint projects like the CoW AMM with CowSwap and investing or being very closely related to QuantAMM and Gyroscope. What we're doing is we're trying to give examples of successful projects or protocols that are built on Balancer. So with the priority fee hook, for example, our main objective is to showcase how to use Balancer V3's hooks and make sure that other devs or teams know, have an example of something that works. So it's really like bootstrapping Balancer V3 or Balancer in general for others to look at us and see there is like cool things that we can build on top of Balancer. So once we have some traction and lots of teams building on top of Balancer and kind of creating cool stuff, then I think more and more our focus will kind of transition to helping others, like unblocking them, as opposed to our team. And there's like many companies or teams in the Balancer ecosystem, as opposed to our teams directly involved in new projects. Like we want to be enabling others to build interesting stuff in the Balancer ecosystem. So that's how I would, if it makes sense, how I would frame it.
Absolutely. Then I want to zoom out even more. So we kind of started off this episode by kind of elucidating how AMMs were initially kind of this stopgap thing that kind of enabled us to kind of do on-chain trading without opening ourselves up to being sandwiched to death. Now that kind of we have much more advanced cryptography, in principle, we could put central ledger order book exchanges back on chain. So do you think AMM are going to be an interim solution, or is there kind of a long-term space for them in the ecosystem?
I think it's the latter. I think there is a long-term space for them in the ecosystem. There is always going to be like the fast trading, like high frequency strategy teams or bots that are probably going to use more concentrated liquidity or PLOBs, centralized limit order books. That is just more efficient, and if you can do that on chain, it's even better. And you have like chains like Solana that want to be, like the ones where people can do that. So it brings with itself scaling problems. There will be L2s on Ethereum that will be kind of more suitable for that. But I do think there's always going to be some space for passive LPs who want to just deploy capital to let's say L1 or an L2 that has higher fees, and they don't want to be like actively trading or managing their positions. So even in today's landscape, let's say in the future nothing like new is created, there's no breakthroughs, which I doubt. I'm pretty sure it's not going to be the case. Even in today's landscape, I think there is space for AMMs. But given that AMMs are evolving and there's like ways you can mitigate LVR and MEV, this is going to be, in my opinion, even more so the case that there is space for AMMs. This is my kind of bet. I could be wrong, but I'm pretty sure. Like some people called AMMs like that. There's just like X times Y equals K, and that's it. And then Uniswap V3 came, and then like lots of things that we're doing came, and I'm sure like in 4 years it will be hard to recognize the space and how much it will have evolved. So I'm on not saying AMMs are going to dominate and be the one in all, but I'm sure there's going to be room for them in the future. I'm pretty sure.
And going on past data in 4 years is going to be when we will have you on again. So kind of we can kind of pick up where we left off then.
Exactly.
So Fernando, where can listeners learn more? Where can they kind of start interacting with the Balancer ecosystem? Where can they start building their own protocols on top? Where can they kind of contribute hooks and so on?
Yeah, I think the best way where you can ask questions and interact is discord.balancer.fi. That's where most technical discussions take place. Of course, there's our forum.balancer.fi, and our docs as well. If you go to balancer.fi, you're going to see all those different links. But also, of course, the X handle @Balancer is where we talk about the latest, and we have some spaces and discuss with partners. So yeah, I think that's where you should find us.
Perfect. Thank you so much for coming on, Fernando.
Thanks, Vidike, for having us. It was a big pleasure.